When you picture a market crash, what comes to mind? For most of us, it's a scene of just pure chaos, right? You've got flashing red screens, terrifying headlines about some global crisis, and just this tidal wave of selling. It feels sudden, emotional, totally driven by fear. But what if that's just the final act of a much longer, quieter play? What if the real cause is something way more mechanical, happening just beneath the surface, long before any of the panic sets in? Today, we're going to dive into this hidden world of market plumbing to figure out what really pulls the trigger on a market crash. And this quote right here, this is the core idea we're going to unpack. It sounds completely backward, I know, but it totally changes how you should look at the market. The argument is that the scary headline, the sudden bad news, that's not the problem. That's just the spark. The real danger is the bone-dry forest that's been waiting for a match. The silent, sudden, and almost total disappearance of something called liquidity. All right, so first, let's tackle the story we all know, the one we hear on the news about why markets suddenly fall apart. It's the narrative that's everywhere, but it might be missing the single most important piece of the puzzle. Okay, so on the left, you've got the myth. Some bad news hits, it triggers this wave of panic, and everyone decides to sell all at once. It's a story all about psychology, but the reality over on the right is way more mechanical. It's a story about plumbing. Crashes really happen when big players are forced to sell. They aren't choosing to get out, they literally have no choice because the system has seized up. So the panic we see on TV, that's just a symptom of a much deeper structural problem. It's not the cause at all. And that brings us to the real culprit. It's this invisible engine that runs the market, and when it stalls, everything just grinds to a halt. To really get why crashes happen, we've got to unlock this secret of liquidity. So what is this all-important liquidity? It's a word you hear thrown around all the time, but what does it actually mean? What are we really talking about when we say a market is liquid? In the simplest terms, liquidity is the grease in the market's gears. It just means there are tons of buyers and sellers around all the time, ready to trade. When liquidity is high, the market is smooth and deep. You can sell, say, $1 million of stock, and the price barely even budges. But when liquidity dries up, those gears grind to a halt. Trying to sell that same $1 million of stock becomes impossible without totally tanking the price, because there just aren't enough buyers willing to take the other side of your trade. Now, I know that definition can still feel a little abstract. So to make this really click, let's think about it like a game I'm pretty sure we've all played. It actually captures this dynamic perfectly. Imagine the entire financial market is just a giant game of musical chairs. The investors are all the players, dancing around happily while the music, a stable, confident market, is playing. The chairs, of course, are the assets you can buy or sell. Now, here's the crucial part, step 3. It's not some scary headline that causes the problem. Instead, the central bank, which kind of controls the money supply, quietly starts taking chairs out of the room. Then, the music stops. All of a sudden, everyone is forced to scramble, not because they're suddenly afraid of the music, but because there are mathematically not enough chairs for everyone. That desperate scramble is the crash. It's forced selling at any price you can get just to find a seat. So, the key takeaway is this. The chaos is caused by the lack of chairs, not by a sudden fear of dancing. And this leads us to the most surprising, most counterintuitive insight of all. Sometimes, the very thing that makes the central bank start removing those chairs is overwhelmingly good news about the economy. I know, it sounds totally backward, but let's walk through how this chain reaction works. Just look at this causal chain, because it's at the heart of so many modern crashes. It all starts with really strong economic news, low unemployment, great growth. That sounds fantastic, right? But to a central bank, that sparks fears of an overheating economy and inflation. So what do? They act. They raise interest rates to cool things down. And this, right here, is the key moment. Raising interest rates is the financial version of taking chairs out of our musical chairs game. It makes money more expensive, which drains liquidity from the whole system. And for the big leveraged players, we're talking huge funds that borrow money to make even bigger bets, this tightening can be fatal. Their costs spike, their models break, and they are forced to sell whatever they can to cover their positions. And that is exactly how good news can directly trigger a market crash. This really reveals the market's one true priority. It cares so much less about whether the economy is good or bad in the way we read about it. It is almost completely obsessed with the flow of money, the plumbing of the system. And this creates a huge difference in perspective. While most of us are watching the headlines, the big professional players are watching these obscure liquidity metrics. They're not watching the weather, they're checking the water pressure in the pipes. And this isn't just a theory. You can see this pattern repeating throughout history. Before the huge stock market collapse of 2008 that everyone remembers, the credit markets, the pipes that carry liquidity, froze up first. In March 2020, these obscure funding markets seized up days before the widespread panic selling in stocks even started. And all through 2022, central bank rate hikes were slowly draining liquidity for months before the major stock indexes really started to tumble. In every single case, the silent removal of chairs came first. The loud, chaotic scramble came second. This whole dynamic also sets up a really dangerous psychological trap, because liquidity often vanishes while the economy still looks strong and the headlines are all positive. It happens when confidence is at its peak. Stability just makes people complacent. Everyone is still out there dancing, enjoying the music, and completely ignoring the fact that chairs are being quietly removed from the room one by one. Risk gets dismissed, and this peak optimism is what makes the whole system so fragile and vulnerable when the music suddenly stops. So when you put all these pieces together, it gives you a whole new lens, a completely different and frankly more powerful way to think about how markets actually work, especially when they're at their breaking points. And that brings us to the final and most important takeaway. Crashes are not sudden storms that appear out of a clear blue sky. They are the final, loud conclusion to a process that happens silently, under the surface, often for many, many months. The real goal, then, shouldn't be to try and predict the exact second the music will stop. That's a fool's errand. The much more valuable skill is to understand the rules of the game itself, to get a feel for the underlying conditions, and most importantly, to keep an eye on how many chairs are actually left in the room. Because in the end, understanding the system will always be more powerful than trying to guess the headlines.